Good evening. My name is Tobias, and these are my colleagues, Murphy, Daniel, George, and Justin. We are the University of Sydney team, and tonight we're going to tell you why you should sell Fairfax Media Limited.
I'm sorry, I don't
The clicker's not.
Sorry, the clicker's not working? Oh.
Fairfax is an integrated metropolitan and regional print and online digital media business operating in Australia and New Zealand, with print advertising revenues accounting for over 75% of newspaper revenue. Fairfax also operates transaction and classified-based businesses such as My Career, Domain, Drive, and an equity stake in Trade Me. Since January 2010, Fairfax's share price has declined 53%, from $1.72 to 80 cents, compared to a 12% decline in the ASX 200 index over the same period. We maintain a sell recommendation on the stock at a target price of 72 cents, representing a 10.3% downside to the current share price. Our sell recommendation is driven by two key factors. First, the significant short-term operational and long-term structural challenges facing Fairfax in the form of a weak consumer environment, as the entire industry shifts from the traditional high-margin print media to the much more competitive low-margin online arena, eroding Fairfax's display and classified advertising revenues, which account for over 80% of group revenues. Second, in transitioning online, Fairfax's strategy has been a case of too little, too late, allowing single-platform digital media businesses such as Seek and carsales.com.au to capture crucial digital advertising share, leaving very little for Fairfax.
The crux of Fairfax's strategy is the migration and monetization of structurally declining print assets onto growth online platforms. This entails three strategic initiatives. Firstly, the remarketing of print display ads as branding platforms. Secondly, the creation of online transaction marketplaces to supplant print classifieds. And finally, the transformation of physical supply routes into a digital value chain. While thematically sound, Fairfax has unfortunately been battered by a confluence of cyclical headwinds and structural pressures. On the print side, cyclical headwinds have overseen 13 consecutive months of negative agency ad spend growth. Structurally, print readership is declining across all developed nations. Fairfax's flagship masthead alone has experienced a 10% decline in readership since 2009. Now, the prospects are somewhat brighter in the digital arena. The 50 billion Australian online economy is the same size as education and retail. Digitally, Fairfax intends to target three high-growth areas: online transaction marketplaces, digital news classifieds, and mobile content applications. While the profits are certainly there, Fairfax faces significant hurdles. Firstly, many of Fairfax's online brands are not category leaders. Secondly, by going digital, Fairfax must now compete with any media platform for engagement time. And finally, lingering doubts remain over how effectively news apps can be monetized. In hindsight, 2011 was a tragic year for Fairfax. In late 2011, Fairfax partially sold its fastest growing and most successful online business to repay debt. In November, after 170 years of association, the founding Fairfax family exited the company. And just recently, mining magnate Gina Rinehart, Asia's richest woman, became Fairfax's largest shareholder. Unfortunately, the opacity of Rinehart's actions add yet another unwanted layer of uncertainty onto the strategic direction of the firm.
Let's take a look at the financials. Based on our DCF valuation, we expect group revenues to decline at an annual rate of -2% across the forecast horizon. A steady decline in print revenues will squeeze EBITDA margins from 25% historically to an average of 20% across the forecast horizon. Likewise, we expect the net profit margin to fall from 12% to 5%, with less than 3% return on equity as Fairfax struggles to generate earnings for its shareholders. The difficulty in monetizing online content will create a revenue gap of $165 million by 2015. Following this structural transition, EPS will stabilize at a lower level of 8 cents, just above half its historical average. At the current price of 80 cents, Fairfax is trading at a forward EV/EBITDA multiple of 6.7 and a forward PE multiple of 11.6. Fairfax is overvalued down to a PE of 9, reflecting a market price of 62 cents. Fairfax's net cash flows have been significantly negative over the past 4 years. This has been caused by a series of poorly timed, debt-financed acquisitions between 2006 and 2009. In 2009, Fairfax was forced to tap $625 million of equity to pay down $780 million of debt. Now, going forward, we do not expect Fairfax's cash flows to improve, and a further $760 million of debt must be repaid this year. The fact that Fairfax has considered selling its recently acquired radio assets and TradeMe is particularly noteworthy. TradeMe is New Zealand's leading online marketplace and the crown jewel of Fairfax's online operations. Proceeds from the November IPO were used to pay down debt, despite Fairfax sitting comfortably within its debt covenants. This suggests to investors that management is expecting a lower margin business with lower cash flows in future. Management also expected the sale to lead to a revaluation of Fairfax's other online assets. This has not happened, and Fairfax continues to trade near its 52-week low of 69 cents.
Our 72-cent per share 12-month target price was reached using a DCF approach and a sum of the parts multiples analysis. In the DCF model, revenue CAGRs over our 4-year forecast horizon were negative for virtually all segments, apart from regional media and online. And this reflects the structural pressures of declining print readership and competitive forces from online media. Free cash flows are predicted to decline over the forecast horizon, migrating from the higher free cash flow yields of the traditional print business to a lower equilibrium due to the competitive pressures Fairfax is now facing and uncertainty in the company's ability to monetize online content. Our DCF model ultimately produced a 67-cent per share valuation, and this method allowed us to reflect the structural risks associated with this print to online transition. The sum of the parts multiples analysis, which drew on 36 unique peers across each of Fairfax's business segments, produced an 82-cent per share valuation, and this was used in conjunction with the DCF value. Our 72-cent target price is 10.3% lower than the current trading price. The key reasons for this are, firstly, the significant uncertainty regarding Fairfax's ability to monetize online content. Secondly, the lack of a coherent management strategy to expand online and improve the company's digital asset portfolio. And lastly, reduced margins from online competition.
Now, we're strongly of the view that Fairfax's future is subject to great uncertainty, both relating to its operations and the company's execution of its stated strategy. With 70 to 80% of its revenues derived from advertising, Fairfax is highly sensitive to swings in consumer and business confidence and retail spending. Going forward, lingering sovereign debt troubles in the Eurozone could lead to continued volatility in the equity markets. A Greek rescue package does little to alleviate global economic weakness, which will continue to depress retail sentiment and investor appetite. Critically, when it comes to strategy, whilst Fairfax has embarked on ambitious plans for print media rationalization, we believe a substantial portion of the projected cost savings is speculative. Importantly, the strategic alliance with News Limited, its biggest competitor, is at best precarious. We also note that migration to online platforms runs the risk of massive margin reduction, with the profit destruction ratio from print to online being around 9:1. We emphasize that digital migration exposes Fairfax to tremendous competition for engagement time. In the online targeted advertising space, Facebook and Google are powerful forces to contend with. Now, given all this, the recent 14% investment by the mining magnate Gina Rinehart brings potential reputational, editorial, and managerial risk to the company, which together with the recent volatile management changes, raises doubts over the company's corporate governance and strategic focus going forward. In light of these uncertainties, our simulation suggests a much greater downside potential relative to the upside. And the biggest contributor to this downside potential is the decline in print media growth rate. This again highlights the risk to Fairfax of the increasing irrelevance of this traditional source of strength. In conclusion, our sell recommendation is based on the significant uncertainties surrounding Fairfax's ability to successfully adapt to fundamental industry change. And our 12-month price target is 72 cents. Thank you for your attention.